You have $15,000 saved. It took discipline, sacrifice, and patience to build it. Now you face a serious decision. Should you use it as a down payment on a house or start a business? This single choice could shape your financial future for years. Many people make this decision emotionally. They choose what feels safe or exciting. But capital allocation should never be emotional. It should be strategic. A house can build equity and stability. A business can generate scalable income. Both are legitimate wealth-building vehicles. The right answer depends on your situation. Are you seeking stability or acceleration? Are you trying to reduce expenses or increase income? Your objective determines the correct path. Clarity must come before commitment. Let's map this out. Stability versus growth. A primary residence provides shelter and stability. Over time, it may appreciate in value. It can also hedge against rising rents, but it does not typically generate income. A business is an income engine. If successful, it can produce cash flow beyond your initial investment. It offers scalability, but it also carries higher risk. Real estate tends to be slower and more stable. Business ventures are volatile but potentially explosive. Your tolerance for uncertainty matters. Financial decisions must match personality. Money in a house becomes illiquid. Accessing it requires selling or refinancing. Business capital may circulate faster. Liquidity affects flexibility. Owning a home requires maintenance, but limited daily involvement. Building a business demands time, focus, and skill. One is mostly passive, the other is highly active. If your income is unstable, starting a business increases pressure. If your job is stable, risk becomes more manageable. Context determines readiness. Foundations matter before expansion. A home builds equity through mortgage payments and appreciation. Each payment increases ownership. Over years, this can become substantial wealth. Slow growth can still be powerful. Real estate markets move in cycles. Appreciation depends on location and timing. A house is not automatically an investment victory. It requires research and patience. With $15,000, you control a much larger asset through a mortgage. This leverage can amplify gains. It can also amplify losses. Debt magnifies outcomes. Mortgage payments act as forced savings. Instead of paying rent, you build ownership. This structure benefits those who struggle with manual investing. Discipline becomes automatic. Homeownership includes taxes, maintenance, insurance, and repairs. These costs reduce effective returns. Ignoring them leads to unrealistic projections. Real analysis requires full accounting. A house provides emotional stability. Predictable housing costs reduce stress.
Stability supports long-term financial planning.
Not all value is purely financial. Money placed into a home cannot be invested elsewhere. If markets outperform real estate, opportunity cost appears. Every allocation excludes alternatives. Decisions carry trade-offs. Real estate is not flexible. Selling takes time and transaction costs. This makes it a long-term commitment. Liquidity sacrifice must be considered. Owning property can hedge against inflation. Rent may rise, but mortgage payments remain fixed. Over time, inflation can benefit borrowers. Debt weakens as currency weakens. For some, homeownership creates psychological and financial grounding. It stabilizes lifestyle before pursuing larger risks. A foundation can support future business ventures. Structure precedes scale. A business does not have capped appreciation. Revenue can multiply far beyond initial capital. Scalability creates asymmetrical returns. Growth potential is significantly higher than a home. Many businesses fail within the first few years. Risk is real and measurable. Starting without preparation increases odds of loss. Skill reduces risk but never removes it. A business converts effort into income. It demands time, strategy, and leadership. Returns correlate with execution quality. This path requires commitment. Business success depends heavily on skill. Marketing, operations, and finance determine outcomes. Capital alone is insufficient. Competence drives results. Unlike a house, a business can produce immediate cash flow. Positive cash flow accelerates reinvestment. This creates compounding through enterprise. Income fuels expansion. Entrepreneurship carries stress. Revenue volatility creates pressure. Responsibility extends beyond yourself if employees are involved. Emotional resilience is required. A successful business becomes a sellable asset. Buyers value stable cash flow. Exit opportunities can generate substantial payouts. Enterprise builds transferable wealth. Profits must be reinvested wisely. Growth requires capital discipline. Spending early profits reduces scaling potential. Structure ensures sustainability. If you lack savings or stable income, business risk increases dramatically. Safety nets matter. Entrepreneurship without runway is dangerous. Timing is critical. A successful business can accelerate wealth faster than real estate. It increases income ceiling dramatically, but it must be managed responsibly. Acceleration without control leads to collapse. Early career individuals may prioritize income growth. Later stage individuals may value stability. Stage of life shapes risk tolerance. Alignment matters more than comparison. This decision does not need to be permanent. Many build a business first, then buy property. Others secure housing first, then launch ventures. Sequence matters more than exclusivity. Maintain reserves. A cushion reduces emotional pressure. Calm decisions outperform reactive ones. Stability enhances execution. Run projections. Compare mortgage costs versus projected business revenue. Numbers reveal clarity, emotion cannot. Financial modeling prevents regret. Do you have business experience? Have you validated demand? Honest self-assessment prevents unnecessary loss. Confidence must match competence. House equals stability. Business equals acceleration. Neither is superior universally. Balance depends on personality and goals. You could allocate part toward business and part toward real estate savings. Diversification reduces single-point failure. Hybrid approaches blend growth and security. Balance reduces regret. Zoom out 10 years. Which path better aligns with your desired lifestyle? Decisions should support vision. Vision guides capital. Are you prepared for business volatility? Are you prepared for mortgage responsibility? Emotional resilience influences outcomes. Psychology drives success. If income is unstable, adding business risk compounds pressure. If income is stable, risk becomes manageable. Foundation first, acceleration second. Choosing one excludes the other temporarily. Reflect carefully. Strategic patience may outperform rushed action. Timing affects results. Do not buy a house because peers are buying. Do not start a business because entrepreneurship is trending. Decisions must be personal and strategic. External pressure leads to misalignment. Protecting your $15,000 is critical. High-risk gambles can erase years of savings. Intelligent risk differs from reckless risk. Preservation precedes growth. Consider testing a business part-time before full commitment. Validate demand before scaling. Evidence reduces uncertainty. Smart experimentation lowers risk. You might invest in REITs instead of buying a home immediately. This provides exposure without heavy commitment. Flexibility can be strategic. Options expand possibilities. Instead of launching from scratch, consider buying an existing small business. Reduce startup risk, improve survival odds. Structure matters. Due diligence protects capital. Let's review these acquisition documents. The best choice integrates into a broader wealth plan. Think beyond this single decision. Build sequentially. Strategy beats impulse. Both paths can succeed. Both can fail. The outcome depends on execution and discipline. Personal alignment determines sustainability. Gather data. Evaluate risk. Assess yourself honestly. Then commit fully to your chosen path. Indecision wastes momentum. $15,000 is not just money, it is opportunity. Choose strategically. Subscribe for more structured insights. Build wisely.